Hi, my name is Stuart Weems and welcome to the Investopoly podcast. Our goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And thank you so much to Campbell Wallace for his episode last Wednesday regarding setting a property investment budget, or really just property budget, can relate to home as well. I thought it was a great episode. Okay, so let's get into today's Q&A episode. And the first question I'm going to answer is from Daniel. Daniel sent in the question a while ago, must have missed it, so we do apologise if that ever happens. Just to let you know, it sort of takes 6 to 8 weeks to answer questions. So the next one I'm going to do after I respond to Daniel's question is from early May, to give you a little bit of an idea on kind of how long it takes. So if we haven't answered in a couple of months, it's possible we've missed it. So feel free to email questions@investopoly.com.au and we'll check on it. Okay, so let's get into Daniel's question then. I'll give you a bit of a rundown. I'll just sort of simplify it a little bit. He's 45 and his wife's 44. They'd like to retire at 60 on around about $90,000 to $100,000 of passive income. Live in eastern suburbs of Melbourne. Home is worth $8,000 to $850,000, no debt, which is a great position to be in. They've got an investment property in Geelong and Grovedale worth about $860,000 with about $340,000 of owing, so sort of 50% LVR. Pretty conservative debt levels. Super is $324 plus $134 for his wife. So what's that? Let's call that $490. Almost $500,000 of super, $20,000 in shares. In terms of their current liabilities, said they've got $380,000 against the investment property. Talks about investment property expenses, annual living expenses about $80,000 to $90,000 a year, and they've got a loan that they did set up for a deposit for a second investment property for $250,000 that's unused. But they decided not to purchase the second investment property because Daniel runs a small family business that's susceptible to government intervention. And if that government intervention occurred, that it could have a significant impact on their income and expenses. And so they decided more conservative gearing levels were more appropriate. So Daniel's wife works part-time, earning $45,000 a year. And the small business in a family trust, actually I said it was a family business, it's a small business in a family trust with about $210,000 of profit per annum, and then obviously the rental income from the investment property. The current plan is to continue to pay down or offset the investment property until it's neutrally geared, then focus on accumulating shares before paying down most of the balance on the investment property. Continue to make concessional contributions of somewhere between $15,000 and $30,000 a year, and use the $250,000 loan to buy US and global shares and Australian ETFs instead of the second investment property. So that's the strategy. And Daniel's got 2 questions for me. Okay, so the first question is, what do I think about the plan in terms of using property shares and super for retirement? And generally, what do I think about the plan that factors in riskier landscape for self-employed people by taking smaller loans rather than one really large one for an investment property? And look, it's a good question. The first thing, when I was reading the sort of rundown, I was thinking, okay, 15 years away from retirement, we've got an investment property in Geelong that's 50% geared. We probably need more gearing. Like that would be, got $500,000 super, keep making super contributions. That balance is going to grow to something relatively considerable. But we all know, the easiest way to build wealth is compounding capital growth. You buy a property, 7% growth, $1 million today, $2 million in 10 years, $4 million in 20 years. So keep that property for 20 years and sell it 5 years after retirement. And it makes a pretty significant contribution to Daniel and his wife's personal financial position. But I acknowledge that if we have some uncertainty around income, it makes sense to be more conservative with borrowing capacity. I'd need to understand really the industry, the business, how income works, how many customers, like there's a concentration risk within the business. Is income contracted? Overall industry landscape will sort of educate me around, whether those concerns are relevant. I find that just generally people that are concerned about things like asset protection or their income changing and so forth tend to be the people that shouldn't be necessarily concerned about those things. And the people that should be concerned about those things tend to not worry about them so much. So it's a bit ironic. Certainly my experience is that the people that are really sort of focused on these things are doing a whole bunch of other things to make sure all those risks don't materialize. Look, if I have a client where we've got a lot of at-risk income, so that is that, look, we think our income's going to be X, but it could be Y, and the delta between X and Y, that could be a significant amount, I will tend to try and build a strategy that allows us to invest money 12 months in arrears. So that is, let's have a strategy. In 12 months' time, we'll work out, okay, what was your surplus cash flow last year, based on all this at-risk income, whether it's sort of bonus or commission-based income, whether you're self-employed, those sorts of things. And if you had a really good year last year, that's great. We'll invest it this year. And so, if you had an extra $120,000 of income last year, investable income, well, great. We'll invest another $10,000 a month into the share market this year. And then next year, if it's a bad year and there's not a lot of surplus income, we'll be investing a lot less in that following year. So that's one way to deal with it. Another way to deal with it is to sort of build in buffers. So, if you say, look, you can afford to buy a $1 million property, go and borrow $1.5 million, for example. Only use the million, but then at least you know that you've got enough debt there to fund the negative cash flow of that particular property really for its entire lifetime. $500,000 will be enough to, fund those holding costs, that negative cash flow. And so that way you can go, well, look, worst case scenario, if my business has a couple of bumpy years, I can ride through it with debt. If my situation changes permanently, okay, I might need to make friends with divesting of a property, but at least I've got this sort of cash buffer that I can rest upon, knowing that this property is going to work. That's another way to do it. I would try to address the concern around income as much as possible, because I think at 45, we've got a 15-year time horizon. In your situation, Daniel, where you've got relatively healthy balances from a superannuation perspective, I reckon the next best step is to go and buy a second investment property. Now, failing that, I think you can use some of that gearing, that 250,000, you could do some regular share investing using some of that gearing. I would certainly be maximizing super contributions. If you're planning to work till 60, then it's really about trying to get as much money into super. So first and foremost, I'd be maximizing the $30,000 each for you and your wife. Now, that might absorb all your surplus cash flow. If it does, that's fine. But then maybe you can add that gearing outside, in personal names into the share market. That's still a good strategy. And I think that both those strategies are going to work. Of course, it's the critical element here is making sure that your super is well invested. As you know, I'll do an episode on that in a couple of weeks' time. When reviewing, the last financial year's worth of performance, I'll of course review longer term performance at that time. I think Daniel said they're both at Aware Super. That's probably not going to be my chosen fund necessarily. So, making sure it's at a fund that's very low fee base and good growth makes a lot of sense. So I guess what I'm saying is that I think an approach like this, it's kind of best to think about, okay, here's a risk. How can I mitigate this risk, rather than here's a concern or risk that I have and let's change the strategy completely on that risk. And sometimes it's appropriate to do that, of course, but it's a little bit like sometimes if you meet people and think, oh, I don't like investing in the share, property's the best thing, it's physical, you can walk through it, bricks and mortar, feel safe, etc. And I've invested in the stock market before, never worked out, it's too risky. If that's their mentality, you go, okay, that's good. But of course, a lot of people have built wealth in the stock market. A lot of people build a lot of wealth in the property market. So of course, that's their data points, is their own experience. But, put that aside and let's look at a rules-based approach. Well, if I've got really uncertain income, but a great asset position like Daniel has, then how do you build a strategy that still allows Daniel to benefit from compounding capital growth? And because Daniel has a concern or a focus on, look, my industry could be, open to government change, chances are Daniel's doing everything possible in his business to sort of protect himself from that. And as a result, how can we make sure that we use the most powerful strategy so that Daniel doesn't look back in 15 years' time and go, oh, I should have geared more heavily when I was in my mid-40s, which is kind of, to some degree, I think that as well. Look back mid-40s is only like 5 years ago, and I was relatively heavily geared. But I look back and go, in my mid-30s, certainly I should have borrowed, probably being a bit more aggressive with my borrowing back at that time. So I think both are going to work, but I think it's about trying to pick the strategy that is the most effectual. Okay, second question from Daniel is, I used a reputable buyer's agent to purchase the investment property. However, in hindsight, we purchased at the height of COVID and are currently sitting on a $60,000 paper loss. But hopefully over the next 15 to 30 years, the property will run through an upward cycle. That's it. Listening to your thoughts on various episodes and your knowledge around Geelong, do you think we should stick with this property? And he sent me a link to the property. I'm not going to provide the address, of course. Well, I know Grovedale really well. That's where the property is located. I went to high school not too far away from that property, and one of my mates lived very close by to that property as well. So suffice to say, I know the location pretty well. I don't think I'd buy a property there. I mean, it's located to a lot of new land supply release. And then look, the other thing, I'm going to record an episode at the end of June, probably 25th of June, I think is the episode. And I haven't written it yet, but one of the things I'm going to talk about, because I'm going to bring all that property stuff together in hopefully one cohesive episode. You know, one of the things is that you've got to think about, if I own property in a particular location, what is going to drive the price forward? You know, how can people in 10, 20 years, how can they afford to pay more? Is it going to be linked to household income, or are there other sources of wealth? And if it's linked to household income, what does the household income need to be for property, the value to exceed $1 million? Right. So inflation will do its thing anyway, right? So you can buy a property and it grows at 3%, and in 30 years' time, it's going to be worth a hell of a lot more than today. But in real terms, of course, all the other money has as well. So, you know, it's only just kept up with inflation. So I'm not saying there's no growth, because there's growth in income as well. But what I'm saying is, you know, what does family income need to be? And I'm going to talk about that in that episode. But that's my concern, is in that location, we've got, you know, a relatively abundant supply of land between Grovedale and Torquay, really, and some of that's already been sort of developed, and more of it will be developed. So there's a strong land supply. And if you're living on that side of Geelong, you know, you might be commuting to Melbourne because there's a train station in Warm Ponds, so it's not too far away. But, you know, it doesn't matter if you live there or 5 minutes closer to Torquay, where there's, again, new blocks that you can buy. So that's the first thing. And the second thing is that the demographic in that location, I think their capacity to pay more will be directly linked to their household income. And so then we need to think about, well, what is the income growth? Because in the long term, property growth really can't exceed, unless there's changes to borrowing capacity, which I don't think there will be, property values really can't exceed that income growth. So I wouldn't probably have bought that property, Daniel, sorry. And, you know, I wouldn't really say that is an investment grade asset either. But you're in there now. I'm not so negative about it. I just think that there's a higher probability that it's not going to perform compared to an investment grade asset. That's not saying that it won't perform though, because of course I'm just saying that there's a lower probability it will. So I say it's a higher risk asset. Look, if I could get my head around going and buying a second investment property, and probably even more reason to do that, just to mitigate risk here, then I'd keep it. But if it's going to be your only property because you really just can't stomach holding too much more debt, then I would sell it and I would buy a house in a very small little cottage in Newtown or something like that, you know, a really blue chip location within Geelong. And I think that, you know, it might give rise to a little bit more debt, of course, but I think that that'll probably do better for you in the long run. But really great question, Daniel, and sorry for missing it. Sorry for taking many months to get to it, but hopefully that helps you. All right, let's get into the next question. The person writes, I should say, thanks for your podcast. Really enjoy the breadth of discussion. Would love your input on my scenario. Please do not use my name if possible, which is why I've used their name. My wife and I want to be able to buy our forever home within the next 7 to 10 years that would fall in a favourable secondary school zone. We're both 30 years old and live in Perth. We're expecting our first child in September and think we're likely to have a second child in 2 to 3 years' time. My wife will have at least 6 months off work, with each child maybe a little bit more. My current income is $120,000 plus super, and my wife's is $170,000 plus super. I can realistically expect my income to get to 140 to 150,000 plus super in the next 5 years, and my wife can expect hers to get to 4 to 450 plus super in 5 years worth of full-time work. So pretty considerable rises in income. We have a house valued at 1.7 and a mortgage of 1.36, which we purchased in the middle of 2024. The house has most of its value, 1.1 million per the bank valuation, as land value, and we think it's an investment grade house. Ideally, we'd like to not sell this house to purchase another one. We have 400,000 sitting in our offset account as we recently sold our first home and paid off that loan and paid our current loan down to 80%. We need to keep some cash so that my wife can have 6 to 12 months off work following the birth of their child. We have no other debts, including HEX, $10,000 of shares, and they do dollar cost averaging of $500 a week. If you were in my situation with the goal of buying a $2.5 to $3 million forever home, what would you do? Okay, so the first thing is I would convert your current loan to interest only. You paid it down to 80%, that's fine. You've got 400 grand in the offset account, but essentially if you want to keep that property as a long-term investment property, and if it's got a heavy land value component in a good area, I think that makes a lot of sense to do that. Then what you want to do is preserve as much of that debt as being future tax deductible as possible. So even though it would give rise to a higher interest rate today, I would convert your home loan into interest only and put the 400,000 in the offset account, and then any future savings that you can muster up, during the period of time when you're building a young family, it can be challenging. You just put those savings in that offset account. The benefit is that you will then preserve the original loan amount, the 1.36. You won't be forced to make any principal repayments against that. And of course, then you can access the cash in the offset account to use as a deposit for your forever home. But at least you're optimizing the debt between those two assets. And then I would buy that forever home as soon as I possibly could. Of course, you have noted that you expect both your incomes, particularly your wife's, to rise significantly over the next few years. I would really focus on trying to make that happen as fast as possible. And maybe, for instance, before you have your second child in 2 to 3 years, maybe that could be the potential good window of opportunity to apply for a loan and go and buy your upgraded home at that particular time. Now, you mentioned a purchase price of 2.5 to 3. The thing is, what we want to do is get that land value in as soon as possible. So that $2.5 to $3 million property is obviously not only a location and land size that you're looking for, but obviously the type of dwelling and standard of dwelling that you're looking at. Well, maybe what you could do is, instead of buying a $3 million property today, in sort of today's dollars, if you like, go and buy a $2 million property that needs a full renovation, for instance. It's about getting that $2 million property, because what you're doing is buying that land, and then you can always renovate down the track. Now, sure, renovating will always cost a little bit more in the future, but probably not nearly as much as what land will cost more in the future. So I'm not too worried about getting priced out in terms of construction costs, renovation costs, all those sorts of things. It's what you really don't want to do is get priced out of a particular location and particular school zone. So the way I'd be thinking about it then is, how can we, over the next 2 to 3 years, maybe before I have that second child, go and buy an investment property, in inverted commas, for $2 to $2.5 million, something that needs work, but something that is good underlying land value, and still the dwelling, hopefully structurally sound, and the floor plan is logical and doesn't need too many changes. And that's what I would look for. And then the benefit of doing that is then you get the negative gearing over the next 7 to 10 years. As you said, you want to do that upgrade in that period of time. And I would imagine the time to sort of make that move would be, in say 5 years' time, when your wife's sort of returning to work, higher income, you've sort of recovered her working capacity and so forth. And then you can sort of stomach a larger mortgage at that point in time. And at that point in time, you just move the money from the offset of your current property into your upgraded home, your forever home, if you like, and focus on just repaying that debt. But try and make that move as soon as possible. Buy a property that's mostly land, that you can then do renovations down the track and then pick the time that you're able to sort of do that. Now, that's the strategy I would use and the strategy that we've used for many clients over the years, and it's always worked really well. Can't really think of a time when it hasn't worked well. Now, the only uncertainty here is whether you move into that property in 3 or 4 years' time, in 7 years' time, or in 10 years' time. But that's okay. You've got the flexibility around deciding when to do that. And that's going to be really based on income versus expenses. So, can you comfortably afford to service that mortgage without the negative gearing benefit and the rental income that goes along with that property? That's just a question in time, a question of fact, really. And your circumstances will dictate when that transition can happen. But it's really about buying that land as soon as you possibly can and then using the negative gearing and the tax deductibility of debt to help you afford those holding costs through that period until you're ready to sort of move into that property. But thank you for the question, and I hope it helps you and everyone else that are kind of in a very similar situation. Okay, next question is from Kay. Kay writes, big fan of your show. I've been listening to it, learning from it for a long time. Thank you for sharing all your knowledge and experience. You're most welcome. My wife is in the process of receiving almost $180,000 inheritance, and she'd like to invest some of that money. She's 34 and only has around $6,000 in super. I think buying some growth ETFs in her name would be a good idea, but given market fluctuations recently and the magnitude of ETFs in the market, it's not easy to zoom on a specific ETF. Which ETF would you suggest for long-term investment, let's say for $100,000? Other than ETF, would you suggest other ways to invest that money? Thanks. So that question was written around the middle of May, so I can understand the references to volatility and so forth. I mean, I guess 34, relatively young, relatively low super balance. So I'd be wondering why is that the case? Kind of need a little bit more information to sort of give some advice or make some suggestions for this person, in terms of income. Do they need to use some of that money for other purposes, to supplement current income, these sorts of things? Do they own a house? Do they plan to buy a house? Should they use most of that, all of that amount as a deposit for a house? Do they have enough borrowing capacity in order to do that? So I don't know. I can't really suggest other ways and what to do with the money because I don't have, enough knowledge around the person's circumstances. But if it was investing in the market, look, the thing you got to think about, particularly, I know this was written back in May, but, I'm recording this in sort of middle of June now. So the market, well, I'm recording this on the 10th of June just for reference, and the share market is really close to all-time highs. Again, it's sort of recovered a lot of that volatility that occurred at the beginning, well, during March and April and May, really. And so markets are their most risky at their all-time highs. Now, of course, markets can continue to run. So I'm not suggesting you shouldn't invest today because, the market's at its peak and it's going to fall from here. Of course, there's been many times, many times over the last 13, 14 years with respect to the US market, that a lot of people, including myself, have thought, well, it just can't keep going at this rate. And it has, and it's continued to progress. So markets can run much, much longer than anyone could expect. But the flip side is that you're investing at the peak. So you're not investing after a 30% drop or 40% drop, which is attractive, difficult to do sometimes, but attractive in the long run. And so you've got to be conscious of that. So look, if I was in that person's position, it sounds like $180,000 inheritance, if you're just judging off the super balance, is a substantial amount of their personal wealth. So they don't want to lose it and they want to do something really smart with it. I try and work out how to get into the property market, probably, specifically if it's a home, because obviously you're going to get the tax-free growth because of the main residence exemption. But if I was hell-bent on investing some in the share market and ETF, I would just go a diversified ETF. Both Vanguard and BetaShares have an all-growth diversified ETF. I think Vanguard's one's a little bit more diversified than BetaShares. Off the top of my head, I haven't looked that up. Either one of those will be good. And I wouldn't invest $100,000 in one hit. I would probably invest, $5,000 to $10,000 a month, just depending on what's happening. If the market continues to be at all-time highs, I'd probably go 5. If it hits a little bit of volatility, I'll probably invest 10 that month. But it's just about regularly investing over that period of time and trying to spread your timing risk. But I would only do it if that person was willing to hang on to that investment for 10 years. If they're not willing to hang on to or make a 10-year commitment to that investment, then I would be a bit cautious about doing it. And I'd be really, as I said, diverting back into thinking, well, how do I get into the property market? But thanks for your question, Kay. Hopefully that gives you a little bit of guidance around that. And actually, I should add some ticket codes on there. So the Beta Shares one is DHHF and the Vanguard one is VDAL. And the Vanguard one has a little bit of small companies exposure, which the Beta Shares one doesn't have. And that was the difference there. Okay, next question is from a couple that want to keep their names and suburbs private. Anyway, I'll read it out. I'd like to echo all the positive feedback that you receive and thank you on behalf of my wife and I for the amazing guidance and direction you've provided in relation to our financial future. We've tried to a couple of times to engage Pro Solution, but disappointingly are yet to fit the bill directly as clients. In light of that, I wanted to ask for which way we should go, as my wife and I haven't been able to agree on it. I'll try to keep it simple and concise. Okay, so firstly, I would say I'm sorry that we weren't able to take you on as clients. I've said in the podcast a few times, it's a very difficult thing. We'd love to help everyone, but of course we can't. And we really want to make sure, absolutely certain that, if we work with a client and a client pays us $5,000 or $6,000 a year for the next 10 years, that's $50,000 or $60,000. We want to make sure that we're working with clients where we both look back over that 10-year period, or hopefully 20-year too, and go, okay, they paid us $50,000, $60,000. We delivered heaps more, maybe 10 times more value over that period of time. We want to do that because that makes us feel good. It makes the clients feel good. And unfortunately, not everyone's situation has enough complexity or enough scope for us to add value and add way more value than what our fees subtract. So that's kind of our thinking here. And unfortunately, because, the cost of advice is still relatively high, unfortunately for a whole variety of reasons, which I've actually spoken about before in the podcast, we can't help everyone. So I apologize for that, but let's see if I can shed a little bit of light on their situation. So there's quite a bit of information here. I'll just sort of summarize it without sort of talking about particular suburbs, but they live in a particular suburb that it sounds like they developed in terms of they built the house and maybe strata titled the property. I'm thinking maybe sold one building off or one part of the land off or something like that, but they live in a suburb that is inferior to the adjoining suburb. They would like to move to the adjoining suburb that is superior both in terms of location. Also, the current property is on a slope. The new property in the adjoining suburb will be on a flat block, no strata, closer to the beach, but it'll be a lesser house because of affordability, just because of the price differentials. And so they've got this property that's probably more building value than land value, or more building value than what they could otherwise buy, on a sloping block that might, and with the strata title property, all these things they're feeling that might impede future capital growth. And they think they might be better off actually buying an adjoining suburb, just a plain vanilla house, so no strata, as I said, close to the beach on a flat block. They could sell their current home for 1.3, and net of all costs and borrowing capacity and so forth, they could repurchase for 1.5. So spending an extra $200,000 to go to this adjoining block. Now, I'll come back to that, but the complicating factor that this person has written in about is that they're planning to move to New Zealand to purchase a business towards the end of this year, and they'll stay in New Zealand for 10 years. And they said they're aware of the 6-year rule, and that's the main resident 6-year rule, and that they plan to utilize that 6-year rule. And I mention this because this could be an important part of the puzzle. The problem, though, is the big question is, will you continue to be an Australian tax resident? Well, you'll need to seek advice on that. You'll need to go to a registered tax agent and see what they think. And it's going to depend on the factors. The residency rules are looking to be changed. They've been proposed to be changed for many years. Parliament hasn't gotten around to legislating those changes yet. And it's going to become more codified, which means that there's kind of 4 tests, and if you meet one of those tests, you are or are not a tax resident. Until that law is changed, the tax residency rules are sort of based on case law and really based on the facts of the situation. But if the ATO thinks that your move to New Zealand isn't temporary And particularly if you're going to, you own, the person said they own property in New Zealand, so you're going to occupy that property. What happens with everything here in Australia? You're buying a business over there. It starts to look like a permanent move. If they think it's permanent, then you will stop being a tax resident here in Australia and you will lose the main residency exemption. So if this is part of your thinking of like, let's upgrade this property before we move to New Zealand, on the hope that you're not going to pay capital gains tax on any gains that occur over that period of time, well, you need to get some advice on that, because it's possible that maybe, in fact, not only will you pay capital gains, but you potentially also, non-residents don't get the 50% CGT discount either. So you'll end up paying 47% on the total gross gain, which is a terrible outcome. Half of your capital gain is gone in tax. It's not going to be a good situation, in which case then you just wouldn't do anything with these properties, and you might even sell your existing one and not have any property. But I just wanted to mention that. Let me circle back to the original question, which is, let's put aside the tax residency issue, just so other listeners can sort of benefit from the answer as well. And let's just assume this couple was going to stay in their location. Look, I think upgrading to an adjoining suburb, even if it's a downgrade in accommodation size and quality, which is what is the case in this situation, in the long run is most likely to be a good idea. So strata title and common, which means we've got common property, maybe a bit of a body corporate, these sorts of things. Look, it depends on the type of property. It doesn't worry everyone, but it's not as good as a Torrens title, which is, just I've got a single title and I control that parcel of land. So I don't think that's a main concern. Maybe in terms of the inferior location, certainly is a thing to sort of factor in. The sloping block's a problem. You want to have a flat usable block as much as possible, but a lot of people don't like a sloping block. Now, it depends on how badly it's sloping, of course, but the deeper the slope, the bigger the problem. So if you sold and upgraded now or moved, I said, to that adjoining suburb, would you be better off in 10 years? I would say probably. Would you be better off in 20 years? I would say almost certainly. So, no one can be sure, because, even inferior suburbs can outgrow blue chip suburbs over the short term. But it's really what we're looking at with property and property-based decisions is, over many decades, what is going to be the right outcome. Of course, that's a difficult decision to make today, but of course, you'll look back in 20 or 30 years' time going, oh, I should have made that change. And that's what you want to sort of avoid. The only thing that I'm concerned with here is whether the difference, the delta between what you've got today versus what you could buy, is going to be enough to be able to do that and make that move with a high level of confidence. So that is sell for 1.3 and buy for 1.5 net of all costs. Is that $200,000 differential enough? I don't know. I don't have the answer to that question. And of course, you would, because you're looking at the particular properties. But as long as you're, to try and fit into a suburb, sometimes you end up making a lot of compromises and you end up with an inferior asset. And so sometimes you might be in a better location, but because of the impairments of the property, and the property might have other impairments into illogical floor plan, a weird shaped block, not in the best street, maybe adjoining a commercial property or something like that, you end up with maybe potentially the same quality asset. So I would do that move in most circumstances, as long as the budget of 1.5 was enough. You're not going to buy a perfect asset. There's no such thing as a perfect asset. But as long as you're going to buy an asset and you're not going to buy something with too many impairments, then I would make the move. But otherwise, you've got to think about it very carefully. If you were saying, look, I'll sell for 1.3 and spend 2, that differential is probably going to normally be enough to move from an average quality asset to a very high quality asset. So that's the only thing that I would be concerned about there. But as I said, you might want to start thinking about getting some advice with respect to residency and delve into it quite deeply. It's something you need some expert advice on. And you might even ask for a private ruling. So this is what we've done with some clients, is that if it's any uncertainty and we're going to be making some significant financial decisions based on what we think in terms of residency, we will apply to the ATO for a private ruling. And the private ruling only covers one financial year, so you might have to do it for many times, but as long as your circumstances haven't changed, then hopefully the answer is not changing either. And you just give them all the details and say, this is what we're doing. We think we're going to continue to be tax residents of Australia. Do you agree? And they'll say yes or no. And at least that gives you some certainty around that decision making. Okay, conscious of time, it's been a long-winded one today. Look forward to joining you tomorrow. Tomorrow I'm going to talk about Vanguard Super. So, I've been talking about super and the super comparison I do at the end of the financial year. I wanted to delve deeply into Vanguard Super because it's a pretty significant entry into the super industry to compete with the industry super funds. Little industry word here, not confusing too many people, but I look forward to sharing that with you tomorrow. Just a few things before we wrap up, if I may. Of course, you can send me questions at questions@investopoly.com.au. But for a quicker response, feel free to add a comment on the episode's video over on YouTube. We have an Investopoly YouTube channel and the link is in the show notes. I'm incredibly grateful for the 4.9 star rating on Apple with over 400 reviews. Thank you so much. If you can leave a review or rating, I'd love it because I'd love to get over 1,000 reviews. That's kind of my target. Keep checking the show notes for free downloads, and I include book discounts there as well. And of course, if you're interested in working with my team and I've included a web link where you can find out a little bit more about what we do and get in touch with us. And of course, until next time, bye for now.